Hello and welcome to the second podcast in the series on general deductions. The general deduction definition is contained in Section 11A of the Income Tax Act. And in this podcast we're going to look at the requirements for there to be expenditure and losses, and for those expenditure and losses to have been actually incurred. Well, we're going to deal with expenditure and loss pretty quickly. There's no real distinction between the two, and it's not important which one you have. The courts have pointed out that expenditure might be intentional, whereas losses might be forced or involuntary, so as the result of something that you didn't intentionally enter into. But whether it's expenditure or loss doesn't really matter. There's no case law that's prescribed in the board syllabus around this, but there are some cases that have debated it. They don't really reveal anything too profound. More important is that the expenditure and loss must be actually incurred. So what does actually incurred mean? Well, in Caltex Oil, the court decided that actually incurred doesn't mean actually paid. It means something different. Does that mean if something has been paid but not yet incurred, that it's deductible? Well, technically it doesn't, but Section 23H deals with prepaid expenditure. And really, I suppose we could say that for the purposes of Section 11A, whether it has been incurred or paid, it meets the requirements of Section 11A. And then if it's a prepayment, Section 23 capital H will tell us how to deal with that. The courts that have also said that actually incurred doesn't mean necessarily incurred. It doesn't mean that you had to incur this expenditure. It only means that you did incur it. So whether or not it was wise, whether or not it was the most efficient way of achieving what you were trying to achieve, that doesn't determine whether it's deductible or not. If you have incurred it, then it meets the requirement of actually incurred. So what does actually incurred mean? Well, it means that the liability is unconditional. The amount itself might be uncertain, and if the amount is uncertain, you can estimate that amount, but the liability must be unconditional. And this was really determined in Edgar's stores. And the case around Edgar's stores arose because Edgar's stores doesn't own the majority of its own stores. Whether you go to the waterfront or Cavendish or wherever, they probably don't own that store. They rent the store, and typically these kind of retail rents have two components to the agreement. One is a basic rental and the other is a turnover rental. And the basic rental normally applies until the point that your turnover exceeds a certain amount. And at that point, you start paying turnover rent, which is rent calculated on a percentage of your turnover. Now, Edgar's stores were accruing for turnover rent every month. And at the end of their tax year, they wanted to deduct the amount of turnover rent that they had accrued. The reality was, though, that they hadn't yet exceeded the minimum amount of turnover that was required for turnover rent to apply. And the court said at year end, you're not unconditionally liable for the turnover rent because you haven't yet exceeded the amount of turnover required. All you're unconditionally liable for is the basic rental. Section 24M says that if an amount is uncertain and it cannot be estimated, then to the extent that it cannot even be estimated, that amount must be carried over to the next year and dealt with in that year. So reading those two sections together, really what we're saying is you must have an unconditional liability. If it's unconditional, you can claim a deduction. If you're not certain of the amount, you can estimate the amount. If you can't estimate the amount even, you should carry it over to next year and deal with it then. But what Edgar's Stores was doing was not only estimating the amount, they were also showing a liability that was not yet unconditional. Let's have a look at some more issues. A provision made in advance of an unconditional liability does not constitute actual expenditure actually incurred. So for example, in the case of Nationale Pass or NASPAS, they were recognizing a provision for bonuses, and they were recognizing a portion of the provision each month until the date that the bonuses became payable. And the court said, until they become payable, you cannot deduct those monthly provisions because you're not unconditionally liable. The employees could resign, you could change your bonus structure, all sorts of things could happen. Until the point that you have to pay those employees and there's no way out, you cannot deduct the provision that you've created. Section 23E says something similar. It says no amount carried to a reserve is deductible. That's partly talking about provisions, but it's also talking about what accountants used to do in the old days, where they used to make a provision for future expenditure. So they would put aside some money this year for the advertising that they were going to do next year. And they would create a reserve for that amount. That reserve is not deductible because nothing has been actually incurred. In golden dumps, the court had to decide about whether a liability has been incurred when it is under dispute. Golden Dumps was a mining company, and they employed a director, and as part of his contract he was entitled to shares in the company. He was subsequently dismissed, and there was a dispute about whether he was entitled to those shares or not. That dispute ran for a couple of years, and eventually the court decided that yes, he was entitled to those shares. At which point Golden Dumps paid him the shares and claimed a Section 11A deduction for the cost. SARS said, you can't deduct that cost now because it was actually incurred when the director performed in terms of his contract, not several years later when the court decided or enforced the payment. And in this case, the court said the amount is not actually incurred until the dispute has been settled. So although the company should have paid him the shares a couple of years ago, the amount or the shares were in dispute until the judgment was delivered, and only at that point was it actually incurred. Then in Ackermans versus SARS, the court decided that a reduction in selling price does not mean that an expense has been actually incurred. Ackermans sold a portion of their business to PEP, and as part of that, PEP accepted contingent liabilities of the business. Ackermans had to reduce the price to reflect those contingent liabilities and the possibility that they would result in a cost to PEP. And so they obviously sold the business for less than they could have otherwise. And they argued that that meant that they had incurred an expense. The court said that they hadn't. The liability went across, or the contingent liability went across to PEP, and only at the point that it became payable, whatever the contingency was got resolved, only at that point did it become actually incurred. Then there's the question about, well, what if you pay for expenditure with your own shares? And in SARS versus Labat or Labat, the court said that that doesn't represent expenditure actually incurred, because there's no cost to the company. The cost is to the existing shareholders, since their shareholding is diluted by the shares that are given in exchange. Then Section 40CA, which is going to replace Section 24B1, says that if you pay for an asset with your own shares, then the cost of that asset is deemed to be the market value of the shares after the acquisition. Now that doesn't mean that you get a deduction automatically for the cost of that asset. What it means is, for the purposes of calculating subsequent deductions like capital allowances, that's the value that we put on the asset. And Section 40CA also says that where debt is issued, the expenditure will be deemed to be an amount equal to the amount of the debt. Then we need to deal with Section 23 capital H, which deals with prepaid expenditure. And what it says is, if you have incurred expenditure and you are only going to receive the benefit or the service either partly or in whole in a subsequent year of assessment, then the deduction is disallowed and only allowed to the extent that it relates to the current year of assessment. So thus far, the same as we would deal with prepayments for accounting purposes. But then section 23H goes on to say that it doesn't apply if all of the goods or services will be received in the 6 months of the following year. So not some portion of them, but all of them will be received in the 6 months. Or if the total expenditure to be limited, so all of your prepayments, excluding those that will be resolved within 6 months, all of the remaining expenditure is less than 100,000 Rand. So not the whole cost, but the prepaid portion of that cost. If all of those, when you add them up, is less than 100,000 Rand, then section 23H doesn't apply. If it's more than 100,000 Rand, it doesn't mean you can deduct the first 100. It either does apply or it doesn't apply. And then finally, if you can show that your expenditure will never result in the goods or services that you were actually paying for. So your supplier has gone bankrupt or can no longer deliver the goods or whatever, then that amount is deductible. That makes sense, because when would you carry it over to if you're never going to receive the goods or services? So that's how we deal with prepayments. If section 23H does apply, then the prepaid portion is deducted in the year that the goods or services are received. If it doesn't apply, then you can still deduct the prepayment in the current year. So let's quickly look at some examples. When are the following actually incurred? Advertising expenses paid in 2012 for a product that will go on sale in 2013. Well, that's actually incurred in 2012, because that is when you've received the advertising. It doesn't matter that the revenue will only come in a subsequent year. Advertising expense in 2012 for a product that was expected to go on sale in 2013 but was subsequently cancelled. Well, you still received the advertising benefit in 2012, you can still deduct that amount in 2012. A payment for damages to a competitor that sued the company. The action by the company was in 2009, the case went to court in 2010, the judgment was handed down in 2011, the amount payable was finalized in 2012, and payment was made in 2013. Well, we're looking at a dispute. So we must look to the principle from Golden Dumps. And that says when you are unconditionally liable, you can make the deduction, and that is when the dispute is settled. This dispute was settled in 2011, so that is when you can make the deduction. You don't know the amount for certain until 2012, but that's okay. You can estimate the amount in 2011, and you can correct your estimate in 2012. And then finally, legal fees to lawyers in respect of the above claim, which cost 50,000 Rand per year. Now, legal fees are deductible under section 11C, but the principle of actually incurred still applies here. When were those amounts actually incurred? Well, they were actually incurred when the lawyers delivered their services to you, not when the case is settled. So 50,000 Rand is incurred in every year and is deductible in each of those years, assuming the requirements of section 11C are met. So what determines when it's deductible? It's not when the case is settled, it's when you receive the goods or services. And presumably that is in each year that they provided them to you. So that's the end of expenditure and loss actually incurred. In the next podcast, we're going to have a look at what it means to be incurred in the production of income. Thanks for watching.